Okay, and at this point then, we can turn the session over to Drs. Kohler and Gallo, who will present the remainder of the session for you. Go ahead, Gus.
Good morning. I'm Gus Kohler. I'm president of Time Structures Incorporated. I had the privilege of meeting many of you at the annual CRA conference in San Jose, and we talked about the calculator at that time, and I'm glad you followed up with getting trained in how to use it. We built it under contract to CRA, and we validated it thanks to Dr. Gallo's careful research 3 times in the past, and we've also defended it before the legislative analysts and have answered many reporters, newspaper reporters, and other media questions about it. We are available to provide you with technical support. CRA is supporting some of that support as well. So with those introductory comments, I'd like to introduce Time Structures economist, Dr. David Gallo. He's a professor of economics at CSU Chico. So take it away, David.
Okay. Let me just kind of give you a rundown of what we're going to cover here. First thing is we're going to go through the various definitions of economic impacts and what they mean. So when you see output, income, state and local revenue, what those include. Also, within each of those impacts, there are what's called direct, indirect, and induced impacts, and I'll explain what those are. And then how you apply the calculator to either individual projects, or if you want to do annual project area construction project completions, you can look at the impacts of annual activity. So let's just get through or get on with this here. So, oops, uh-oh. My screen doesn't seem to be, oh, there we go. Okay, so first of all, why you need a model to calculate these impacts? Well, certainly ongoing state budget problems place your funding at risk. Legislature believes or seems to be able to argue that the purpose of diverting funds from redevelopment is to reduce the state budget deficit. What we'll see is that that's actually not the case, or at least it's not dollar for dollar a reduction in the budget deficit. And finally, to show how your projects support local and state economies. Okay, so the model calculates the impact of individual redevelopment projects on 4 measures of economic impact. Business revenues, which is sort of the total economic activity that occurs in an area, and in this case we're doing statewide. Income, which we'll go through the definition of that, employment, and then state and local revenues. And certainly the model also helps with determining the local job impact. Sort of depends on the size and maturity of the construction sector within a county or within a city, but generally about 60 to, in some cases, over 90% of the jobs are local. Okay, total business revenues. These are actually gross sales, and they're only gross sales by businesses located in California. This is called output, and it's really a measure of the total economic activity associated with a project. Income is what you end up with in terms, okay, so take business revenues and you subtract your purchases from suppliers, some of them in-state, some of them out-of-state, and what's left over is income. That includes wages, rent, property income, proprietor income, and some what's called indirect business taxes. Employment is total full and part-time jobs generated during the project construction phase. You'll note that it doesn't include project operations, so if the development is, say, a commercial entity, those jobs generated within that business are not included in the calculator. And finally, state and local revenues, and that includes all revenue sources accruing to the state and local governments. And again, just during the construction phase of the project. Okay, and all impacts include indirect and induced effects, which I'll explain in a minute, that arise from the direct construction activity. Okay, so what's direct? Direct is the business revenues, income, employment, state and local revenues directly connected to the construction project. And I'll actually go through an example of how these are separated out. Induced impact or indirect impacts are due to the purchases of inputs from businesses that are located within the state. It doesn't include any out-of-state purchases. Those are not included in the total impact. So if, for instance, if you're building a house and you buy concrete, you buy lumber, the indirect impacts are what occurs in those secondary industries. Now, induced impacts, they arise from the spending of the income received by in-state businesses and their employees in the industries that are affected directly or indirectly. So we take the direct income, the indirect income, part of that is spent with businesses located within the state, and that's calculated as the induced impact. Finally, total impact is just the sum of those three impact categories. All right, so any project is going to involve both local and state businesses. So lumber could come from other counties or from out of state. If it's from out of state, it's not included in the impact. Pre-hung windows and doors certainly involve multiple resources to build and transport them. And so project construction involves a collection of interacting businesses. And what the in-plan model does is it traces out those interactions among the various businesses. So it says when you build a house, you spend X number of dollars buying pre-hung windows and doors. You spend Y number of dollars on lumber. And the model also calculates what percentage of that will come from in-state businesses. And all this is based on data from Bureau of Economic Analysis, which is housed within the U.S. Department of Commerce. Okay, total income. So this is just to kind of show you how, then this same thing can be done for output or employment, but I just thought I'd run through an example with total income. So direct income, you take the cost of the project minus what inputs are purchased. Okay, and for indirect income, take the input sales to the project and then subtract that part that goes to out-of-state businesses. And induced income, take the spending from the direct and indirect income minus what part of that spending occurs out of state. Out of state may mean someplace else in the country, or it may mean internationally, maybe imports. So if we look at single-family housing, let's say you build $1 million worth of single-family homes, that generates $409,000 in direct income. It also generates another $210,000 in indirect income from in-state suppliers of lumber, concrete, and so on. So total direct plus indirect is $619,000. Then we take that, how much of that is spent within state businesses, and that becomes induced income. So that's $200,000 in induced income. So we add all three up, and we get $819,000. So out of that $1 million, that's what ends up in the pockets of California businesses and their employees. That's the actual income component. Okay, so question that's come up is why not a model that estimates local economic impacts? And the local multipliers at the county and city level, they vary by jurisdiction. There can be a considerable amount of variation county to county, city to city. And so if we were to calculate these local impacts, we would actually have to produce a separate model for each jurisdiction, each city, each county redevelopment agency. And the data for any unit smaller than a county involves actually a separate purchase from Minnesota Implant Group, who is the marketer of the implant model. And they're actually the sub-county level models aren't that reliable, the way they allocate the spending. So we resources, because the state would like to know what the impact is on the state as a whole. Most of the statewide impact does occur locally. As I said, particularly with the county, it's a county level analysis. And finally, as an example, if you look at single family housing construction in Sacramento County, 90% of the business sales, that's the output, and income, and 94% of the employment occur within the county, and that's as a percentage of the statewide impact. All right, so model is based on this implant input-output model, and one thing that's important to know is that it is fairly widely accepted. It's used in a number of analyses. There's actually only one well-accepted alternative that I know of. And state government clients include California Department of Finance, Transportation, Water Resources, and the Water Resources Control Board. Okay, so let's take an initial look at this model. Oops, there we go. Lost my cursor there. And let's get back to the data entry. All right, this is relatively simple, but let me explain what goes into this. This is where you put the data in. This is the total project construction cost. And in later slides, we'll talk about how you actually come up with that number. And so each sector differs. So for instance, if you're putting in new manufacturing industrial, it goes in this cell, new commercial goes in that cell, new utility construction goes in that cell, and then these first ones are all inside project areas. You'll notice the title here. And then also we do agency financed new construction outside of project areas, and then rehabilitation construction in project areas and outside. Now, that's not absolutely the most important thing. The most important thing is to get things in the right sector, because these sectors are what determines the size of the multipliers. All right, so let's kind of just go across on one row. So for new manufacturing industrial, we find that each $1 million in construction spending generates 1.8 million in total business revenues or output. So the multiplier is essentially 1.83. Okay, this comes from the implant model. This also includes the direct, the indirect, and the induced. So each of these entries already includes those three components. Okay, here's income per $1 million in construction spending. Okay, we did it for single-family homes, which you'll notice it's 918,000, which is what I got for the total impact. Okay, employment per $1 million of construction spending, and state and local revenues per $1 million of construction spending. So what the model does is it calculates the total output, and if we just double-click on this, you'll see it's just the project construction cost for that sector times the amount of output per $1 million of construction spending, and then of course divided by 1 million to get it in total. And so that's done for output, income, employment, and state and local revenues. Now, a caution which you'll hear me mention several times is these are all summation formulas here. These just sum up all the sector impacts. And so you don't put anything in these shaded cells. That's why there are already numbers there. They're zeros only because we didn't put anything in yet. So for instance, if we put in, let's say, 10 million, oops, I'll try to do it. Okay, 10 million here. you'll notice that it calculates total output, total income. For some reason or other, it didn't calculate total employment. Okay, I don't know what I did there, but and then it sums it up down here at the bottom. Okay, and also puts the total impacts over in this sort of summary table down here. So better get that out of there since I obviously did something wrong there. Oh, I see. Never mind. Fix that. There we go. That could cause trouble later. Okay, so now the red tab is the instructions for using the model. And so numbers 1 and 2 are the instructions for the user inputs. Numbers 3 through 5 describe the model outputs. And number 1 instructs you to enter the project costs under the appropriate construction sector, and again, not to make any entries in the shaded cells. And number 2 also instructs the user to enter the agency's expenditures connected to the particular projects. Okay, so let's go back and look at the instructions. So, enter the total cost of the project, including any private money, in the cell best describing the type of construction. I keep telling you, do not use the shaded cells. The agency cost of the project goes in the yellow box. We'll talk about how you calculate that. And this all talks about what it calculates. So, again, you enter the agency or the total project construction costs in these cells in column B, and the agency cost goes right there in the under the agency cost, the yellow cell. All right. Okay, so what's included in project agency project cost? Okay, this is the tough one. With most of the questions we've had about this calculator refer to how do we do this. You need to include all project-related costs, but only those that are assumed by the agency. Okay, if the agency assumes certain initial costs but is reimbursed, then they should not be included. And must also allocate a share of the administrator or overhead cost according to the percentage of time spent on the particular project. And agency cost categories are in these 2 tabs, one under construction cost categories and then the other agency costs. This is definitely a case where you should probably get help. You have somebody preparing pro forma statements, and they would be the people best able to put this together. So let's go back and look at those 2 tabs. And all right, so these are the construction cost categories. It just identifies, what things go into that: site clearance cost, project improvement construction cost, disposal costs, and so on. These are also included under project cost. Now, the other agency costs go in agency costs but are not part of construction costs. So real estate purchase, land acquisition, building acquisition, you acquire existing improvements, income and expenses during pre-development, income and expenses during construction. These are things that do not go in the column B entries, but do go in the yellow agency cost tab. All right. Total cost of the project is agency cost plus any private investment. And, of course, the agency's project-associated costs. So the important thing here is what goes in that column B is the total cost of the project, includes any agency money that went into it and any private money that went into it. Again, the project construction costs come from the pro forma statement. They are entered in the data tab, again in column B. And again, product column B, unshaded cells only, and agency costs in B51. That's that yellow cell. One more time. Hope I'm not overdoing this, but I want to make sure everybody understands. So all the total costs go on these cells, right, the appropriate level, and agency cost goes in here. Okay, model outputs. You got total business revenues or total output. That's in B50. D50 is income. E50 is employment. F50 is state and local revenues. And then agency cost per job is calculated at H51, which is just total agency cost divided by the number of jobs. We'll look at those in a minute. And then all of these are calculated in row 52 as revenues, income, employment, and state and local revenues per $1 million of agency spending. Those are particularly important because they essentially are a measure of the efficiency or the effectiveness of agency activities. So let's look at those again. So here are all the summary impacts. This is total output, total income, total employment, total revenues, and then this is impact per $1 million of agency cost. So again, it's, you can see B51, which is agency cost, goes in the denominator. And again, for output, income, employment, state and local revenues. And then agency cost per job created is simply agency cost divided by E50. Okay. Now, there are also some additional graphics which you might find useful for doing reports. There's a type of spending chart. Looks at division between new construction and rehabilitation spending. And the type of construction percentage chart, it's just a pie chart. And sum by construction type, which are tables. So go back and look at those tabs, and those are on the far left. So type of spending chart looks pretty flat. When you enter data, obviously it expands. So it says new construction, rehabilitation, construction, and total. Type, doesn't look much like a pie chart, but it is residential, industrial, commercial, utility, and then public infrastructure. And then here are the tables that are generated with the same data in it. We'll later do examples that actually have some data, and you can get a little better look at those portions of the model. Okay, so summarize one more time. Oops. There we go. I'm trying. Oh, there it is. All right. So you put numbers in here. It does all the calculations for you. You put agency cost in there for either the individual project or a sum total of all the projects that were completed in a particular year. It gives you the total impacts on line 50. Gives you the impacts per $1 million of agency spending on line 52, and gives you agency cost per job over here on cell H51. Okay, all of the economic impact measures are important, but the focus here is on state and local revenues per $1 million of spending. So since the rationale for taking money from redevelopment is to reduce the state budget deficit, the question is how much does it actually reduce it? And in our study in 2006-2007 redevelopment agency activity, we found that each dollar of agency spending generated 64 cents in state and local revenues. So the actual reduction in the budget is only going to be 36 cents for each dollar eliminated. So for each $1 million taken from redevelopment, the state budget deficit is only reduced by 360,000, not the full million. So it provides a stronger argument against shifting that money out of redevelopment. And projects that leverage more than the average amount of private funds, the impact on the state budget is even smaller. And of course, the corollary to that is for projects that are purely publicly funded and don't involve private money are going to look a little worse in terms of this jobs calculator. Excuse me, but that doesn't mean they're not important. Okay, so other impact measures, this is those line 52 calculations we did for all redevelopment activity that year. So for every $1 million spent by redevelopment, business revenues or output increased by 13.02 million, income increased by 7.26 million, and employment was increased by 97 jobs. Okay, so I've worked up a couple of examples here that this first one is just a residential development entirely within a project area. Includes single family, multifamily, some low moderate income, other unrestricted, and includes some infrastructure in terms of streets, water, sewer, utilities, and some improvements to existing streets. And take a look at this one. And you can see, again, you can see how these shaded cells work. For instance, this residential low and moderate income is just the sum of the new single family and the new multifamily, the 33 million. So it just is the sum of those two. All right, so you've got new utility construction, single family, multifamily, and then 8 million in new single family unrestricted. So total new single family is the sum of the unrestricted plus low moderate income. New streets and bridges, new water and sewer, some street improvements. And so our total expenditures for this project are 51.5 million. Total impacts are 95 million in output. We can just look down here. We don't have to look on line 46. 95.5 million. Income is 50.2 million. 662 jobs and 4.5 million in state and local revenues. Now the agency cost for this hypothetical project is 6.8 million. So we look at line 52, which is impact per $1 million of agency expenditure, and we got 14 million in output, 7.4 million in income, 97 jobs, and $666,000 in state and local revenues. So this is pretty consistent with what we found for the average for all redevelopment activities in 2006, 2007. Okay, so another example, and this is sort of a mixed use that involves some infrastructure improvements outside the project area, some industrial, commercial, and residential structures. Again, just to illustrate, again, you'll notice there's entries for manufacturing, industrial, new commercial, utilities, and again, all these shaded cells are just summing things up for calculating impacts. Go down here, total impacts 212 million on output, 120 million in income, 1,600 jobs, and 10.5 million in state and local revenues. Again, agency impact per million, or impact per $1 million of agency spending, a little over 12 million for output, 6.8 million for income, 92 jobs, 602,000 in state and local revenues. And in this case, the agency cost per job is 10,800. All right. Oops. Sorry about that. Oh, that's it. So I guess we turn it back over to Roger for questions. All right. Hello? Roger, are you there?
Yes, I am.
Oh.
I'm sorry, I've been on another line regarding...
Oh, I thought all of a sudden my internet wasn't working. That was scary.
No, it's working fine. What's going on right now?
Well, I thought we'd take questions.
Oh, okay. We can do that. But if you can, for just a few moments, if you can receive the questions, let's see, hang on. Let's see, yeah, okay. We have a question from Tracy Reed. Go ahead, Tracy.
Can you hear me?
Yes, I can.
Good. I've got a conference room with about 6 or 7 people, and we've got one person that wants to give you, we're doing a lot of CIP type projects.
Uh-huh.
So we're doing about just a $2 million sidewalk project.
Okay.
Do you want to give me the numbers, or? Go ahead. Okay. That's what we're typically doing, is just a straight, the agency's paying for the entire thing, and we're just wanting to see if we've been using the calculator correctly. It's just a simple, and it doesn't really, we wanted to double check to see what category we need to put that number into. We've been using the other under public improvements. But it's all agency funds, $2 million to do sidewalk repair and replace, and we'd like to see how, if this kind of jives with what we've been doing. The person that did that, I don't have that information in front of me, but that was just the example that was given to me.
I would say logically you'd put it into streets and bridges, sector 39 on line 17 if it's new, and street improvements if it's not new.
Okay.
That would be the sector that matches closest to that activity.
So new streets, what were you saying the other one was? What other category?
Or new.
Street improvements for if you're
Okay.
just upgrading.
Okay.
What about street lights?
Would streetlights come under that same category?
Yes, probably they would.
Our predominant work right now is sidewalks, streetlights, traffic signals.
Yeah, I would put that all under street improvements.
Okay.
So just put $2 million in and see what happens?
Yeah, could you just put $2 million in? Would it just, is that
Under
just
street improvements?
Yes, please.
That's all we have.
All right. There we go. And agency costs is $2 million?
Yeah.
Okay, so your total impact on output is 3.9 million, income 2.24 million, and 31 jobs.
Yeah, it's so simple. It's kind of scary that it works so easily.
Well, that's
and that's what we've been doing. We've been noting it in our staff reports that we're using the CRA job calculator, because it's become such a big issue.
What's the issue?
Well, the issue is, where did you get that number from?
Ah.
And we're just noting that in the staff reports that we're using this program to get that number, and it's been accepted pretty well.
Yeah, I think the operative word is it's the in-plan model.
Okay.
Which is fairly broadly accepted. I think the jobs calculator is somehow perhaps created by CRA.
Right.
And therefore
I think that's how we've noted it as CRA, job calculator.
Yeah, well, it's really the in-plan model that's doing this. All I've done is taken the multipliers out of the in-plan model and plugged them into column D.
Okay, so maybe we should include that as part of our footnote.
I think you should, and
Okay.
just reference it to Minnesota In-Plan Group, MIG.
Okay, thank you very much.
You're welcome.
Okay, we have another question from Keith Roberts or others at his site. Go ahead, Keith. Keith Roberts, you have a question. You have your hand raised. All right, how about James Wong? James, you have a question or someone at your site. Go ahead. Hello, folks at the James Wong site. You've been unmuted. You can use your telephone to ask your question. All right, how about Colette Hanna? Anyone at the site? Colette Hanna, you're on your microphone. We're probably not going to be able to hear you. You can try, but we can't hear you, Colette. Your microphone is not getting through to us. If you want to ask a question, please join the telephone conference call. All right. Don Frazier, go ahead, Don.
Oh, thanks, Roger. David, the question I had for you is a lot of agencies subsidize development by rebating a portion of future tax increment from the development site itself. And I'm wondering how you recommend you calculate that in agency costs. Would you suggest we do some type of present value calculation for the revenue stream and include that in the agency cost category?
Yeah, that's what I'd do. The question is what discount rate you would use in the net present value calculation.
Yeah, I'm a consultant, and I mean, we typically would use something like cost of money, whatever current cost of money is to agencies. But yeah, I mean, you're right. That's an issue that can be questioned. But that's fairly typical in addition to doing infrastructure that agencies put some future increment flow into the project. Right.
Yeah, I would, I generally use, when I'm doing statewide impacts, I use the state's cost of borrowing as a discount rate.
Great, thanks. Nice model. I think it should be helpful for a lot of agencies.
Okay, thanks, Don. All right, next, Dory Boyer or others at that site. You have your hand raised. Go ahead. At Ventura, Dory Boyer and others. Hello? At the city. Yeah, we can hear you. Go ahead.
Hi. Yeah, mainly our question is, we came in a little late, so on the income, over what period is that income calculated?
Just during the construction phase of the project.
Just the construction phase. Okay, right. Thank you. That's all we need to know. Thanks.
Okay.
All right. How about Flavio Nunez? Flavio, you have a question?
Can you hear me?
Yes, I can hear you. Go ahead.
Okay. That previous example that we just looked at, street improvements, the numbers were put in the inside the project area category. If you were to put it outside the project category, how do the numbers or total output numbers change, or do they change?
They don't at all.
Okay.
No. It's just that we wanted to separate them out, but they're all summed in the same sector, so it really doesn't make any difference to the total impact.
Okay, thank you.
All right, next question is from Greg Suhu. Greg, go ahead.
Hi, this is Greg Suhu from Kaiser Merson. I noticed that the model itself, which is great, uses factors that are fixed numbers, and I was wondering how frequently those need to be updated over time, numbers specifically on columns D and E and G, for example.
They don't change very much. I've used in-plan versions from 1997 to the present, and there isn't a lot of difference in the numbers year to year. There was some change from about 2001 or 2002 to about 2005 or 6. The numbers got a little smaller in terms of the employment impacts because of productivity increases. But no, they don't change very much. They're pretty close to what you'd get in virtually any data set from 2005 to the present.
Thank you.
All right.
Okay, again, James Wong or others at the City of Pasadena, you have a question. Your hand raised at City of Pasadena. You have no question. All right, we're going to move on. All right, we're trying Ricardo Noguera, but you're on your speaker. Ricardo, see if we can get you off your microphone. Go ahead. Ricardo Noguera at Visalia. We can't hear you through your microphone. Ricardo, if you want to ask a question, please call in to the telephone conference call. Okay, moving on. it appears that those are all the questions we have that we can take from folks on the phone. Again, James Wong, Pasadena. You're on the phone, but we're not hearing you if you're trying to talk to us, and we have unmuted your phone. All right, we're going to move on. Okay, David, go ahead. Did you want to proceed with more of your presentation?
Well, the presentation's complete.
Okay.
That's why we're in question phase here.
Okay. Well, I'm scanning again through the attendee list. Tracy Reed, your hand is still raised, or are you completed with your question?
We have one more question here.
Okay, go ahead.
Jobs created, is that for 1 year? Construction jobs, at the bottom of the table, we're wondering over each time. And how does that work link with the phasing of projects if we know there's a 2-year construction time frame? How do you take all that into account?
Okay, well, let me explain a little bit about employment definitions. This is a Department of Commerce definition of employment that's used here, because this is all Department of Commerce data. Department of Commerce defines a job as anybody who worked 1 or more hours in the preceding week. Okay, so these are in no sense full-time jobs. I mean, that doesn't mean any significant percentage of these employees worked only 1 hour. It just means there is no full-time job equivalent. So these are just, you can't even say these are person years. Okay, this is simply jobs created during the construction phase.
Okay. So just any one time, not over any period of time at all?
Well, if it's a 2-year project, half the jobs would be in each year.
Okay, so it is.
If the spending was split evenly, then the jobs would be split evenly as well, roughly.
So it is per year?
Yeah, but it's not per year as if it's full-time. See, that's what I want to emphasize that. It's just jobs during. So if you spend, $2 million in construction, you create, X number of jobs over that construction period. But that doesn't mean that if it's $1 million in 1 year, it's half that number of jobs in that year.
Okay.
Okay.
Thank you.
All right.
All right, folks, any other questions on the in-plan model or the jobs calculator? This is your opportunity to get your questions answered so that you may make more effective use of the jobs calculator. And Gus, you had a comment you wanted to make. Please go ahead.
Yeah, I wanted to make 2 comments that follow up a little bit on the last question. I think the way David and I designed this, we looked at completed construction during 1 year, and some of that construction could have been started, years before, but it was a project that was completed during that year. So when the number comes out, it's for that building that particular project. You created that many jobs. Now, another approach which really doesn't fit well with a calculator is to sort of break the project up into phases and say, like this year was phase 1 or something, and we did so many jobs, and then next year phase 2 involved another number of jobs. Turns out that the tracking of that is very difficult, and so we designed it so that we were looking at each year at the number of projects that were completed in that 1 year. And in our opinion, the best way to present that data is to show how, for your agency, since you maybe didn't complete more than, maybe you complete 1 project 1 year, and then the following year you don't complete any projects, and the year after that you complete 4. So we feel that it's the most meaningful way to show what you're doing is to have maybe 5 years worth of completed projects, and then show each additional year how many are going on, are coming on board. That's a little extra work, but as you do each year's projects, if you can only do one at a time, it'll begin to accumulate, and you'll have a little trend going on, which I think is really important. The other thing is, if you look at the chart, it could be intimidating because there's so many numbers on there. But as David has constantly emphasized, you're just putting your numbers. You only have to put in 2 numbers, you know, more or less. One in the total project construction cost column, and then the agency costs. I found the interesting thing for me personally was to realize that I can actually see which of these sectors are contributing the most to the job generation, because I can see by looking at the multipliers and going across the rows for each of the projects where I'm really getting the biggest bang or the least bang for the buck. And that comes up also in the charts that David put together. Now, I think there's something that's tended to be underemphasized as we've used this model to assist redevelopment to show what they're doing, and that is the tax impact. David might want to talk about this a little bit more, but that's actually a remarkable and useful tool, because you can really show that what you're doing is benefiting state and local government to a large degree. And this was his point, that, you know, for every dollar you put in, really the state's trying to save money. They're only going to save 35 cents because the rest of that is being lost in taxes generated. So that's my comment.
Okay, thank you very much. At this point, we're going to, I'm going to take the presentation back, and I want you to stay with me for just a moment, folks. We have 2 quick poll questions that we would like you to respond to for us. Let's see, hang on here 1 second. Okay, 2 quick poll questions. First, we would ask you how many attendees are at your site. If you would, please use your mouse cursor to click on one of those responses to let us know how many folks are physically present there at your site that have taken advantage of this training. We encourage multiple attendees so that more people can take advantage of the training. Okay, there we go. There's your poll. Please quickly tell us how many folks were on site at your site. We've got almost everyone has voted at this point. We appreciate your quick response. It appears that at the majority of sites, there's been only 1 or 2 people. A few sites had 3, 4, and 5, and that's wonderful. We appreciate that. You're taking advantage of that. Finally, we would ask you how useful has this session been for you. Quickly, if you would give us your response as to how many of you found this session to be useful in terms of understanding how you are to use the jobs calculator or understanding the workings of the in-plan model. All right, the great majority have found it very useful or useful. A handful has found it not useful. We would appreciate an email message to either Gus or myself telling us why it was you found the session to be not useful. Again, we want to thank our sponsor, Buxton, for having sponsored this event for us, and we certainly want to thank Gus and David and Time Structures Incorporated for their wonderful work in creating this calculator for us that can be so effective in calculating the economic impact of your redevelopment activity. This concludes our webinar. Thank you, David and Gus, for your presentation and for sticking with us here, and for your willingness to respond to folks' questions after this event in terms of how they can use the jobs calculator. We will be posting a recording of this event on the CRA website so that anyone who is not able to take advantage of this session will be able to do so by accessing it on our website. And that concludes our webinar, folks. Thank you very much for having attended this session for us, and we appreciate your patience and your being with us through this session, and most specifically, we will appreciate your use of the jobs calculator to calculate the economic impact of your redevelopment projects and get the word out about that to the folks in your community, to your local media, especially to your legislators who are considering various budget measures and reform measures and in the state legislature. Make sure your legislators understand the jobs impact of your redevelopment activity. Thank you very much for being with us, and have a good day.